المحاور الثالث الدكتور أسادور خبيان، هو مستثمر ومستشار في شؤون التداول وصاحب كتاب Born Again Trader. سيحدثنا عن العامل النفسي وراء عملية التداول.
Good morning. Before I start, I just wanted to thank Mr. Jihad and FX Pro for giving me this opportunity to share my thoughts and perspective towards the financial market. We live in a society where most people are afraid to make mistakes because we are conditioned that mistakes are for failures, and no one wants to look like a failure in the eyes of society. And that's the main reason why most people are afraid to take risks, are afraid to learn and experience something new, are afraid to get out from their comfort zones. But the irony of life is that the only way to grow as a person is by actually going through failure, is by actually making mistakes, because that's how you will learn and evolve as a person. And it's the same thing in trading. The only way to grow as a trader is by accepting the fact that making mistakes is a necessary part of the process. You see, it took me 3 years. 3 years of hard work, dedication, and sacrifice just to break even in the market. Some people quit after 3 or 4 months because the results didn't meet their expectations. And that's exactly the problem that most people are facing. They approach the market as if it's just a game, or a get-rich-quick scheme, or my favorite one, a roulette table. They approach the market and bet their money as if they're betting on the color red. If it hits, they double their money, everyone is happy. But when it doesn't, they start creating these misconceptions in their minds that trading is gambling and the market is rigged against them. Now, this lack of proper education in this field inspired me to write my own book and to create Legendary Trades, which is my online trading community with more than 16,000 followers, where I teach my members to develop the necessary skills in order to succeed in the markets. So today, I'm here to share with you in 3 important points why making mistakes is a necessary part in your trading journey. Let's start with the first point, which is perspective. When I first started trading, I used to analyze charts like this. And now, after 7 years in the market, this same chart became like this. So what do you think is the main difference between those 2 charts? It's one word: simplicity. See, trading can be simple, or it can be complicated. It can be clear, or it can be confusing. It all depends on you and how you want to approach it. But before we can simplify the financial market, we need to go back to the roots and ask some questions. So let's start by the simple question: what creates a market? And the simplest answer is, and the obvious, demand and supply. It is a universal truth, we all know it, but it's not enough. We need to go deeper and ask the question differently. So instead of what, let's ask who. Who creates the market? And the answer is us, human beings. We are the reason why demand and supply exist in the market, which is also true, but again, not enough. We need to ask one more question, which is the most important one. What drives us to buy and sell? What is the underlying factor that is letting us to create a demand and supply in the market? And the answer is our emotions. See, neuroscientists proved lately that every decision we take is based on emotions. Even the ones that we think that are pure logical and rational, there's always an emotion involved in the decision-making process. So imagine now the magnitude of the emotional impulses that exist in the financial market. Every trader has a different emotional state, different perspective, different opinion. That's why the market is regarded by most people as a very risky and random environment. But in reality, it only looks risky and random to the uninitiated. Just like Warren Buffett said, risk comes from not knowing what you're doing. So once you understand that the market is mainly moved by emotions, and more specifically by two dominant emotions, which are fear and greed, and that those two emotions are quantifiable, your perspective will change forever. But still, the question remains, how can we keep track on the emotional state of every trader and investor in the market? Unfortunately, we have the tool that gives us the most unbiased information that we need, which are called charts, which will take me to my second point. What are charts? John Murphy, a very famous trader and an author, once said, "The illusion of randomness gradually disappears as the skill in chart reading improves." That means the more you understand charts and what they actually represent, the more you will become aware that trading isn't random at all. Because charts are the language of the market. And you can never understand the market if you don't learn its language. For example, you can never become a computer programmer if you don't know how to write a code. C++, Java, and many other languages. You need to know at least one of them to write a specific program. So it's the same thing in trading. If you don't know how to analyze a chart properly, then the odds of you becoming a successful trader is heavily against you. Because charts, at the end of the day, they represent us, our collective emotions, our fears, our greed, our thoughts and needs. Charts are not magic balls that traders wish upon. They are used to guide us and inform us on the overall sentiment of the market. So, if the sole purpose of a chart is to translate our emotions into lines on a graph, then that means the market isn't a separate entity. It is merely our reflection, our collective thoughts, our perspectives, and ultimately, our emotions. So you see, the key of mastering the markets is actually mastering the collective human behavior in the market. Let me explain how. Research shows that human behavior is 93% predictable. That means every one of us here has a 93% probability to act in the same way under certain circumstances. And the perfect example is the financial market. For example, when the media injects fear in the market, how would most traders react? The buyers will start selling their positions out of fear. At the same time, this invites new sellers to the market to come and join and take advantage of this panic out of greed. And on the other hand, when the market gets greedy, just like Bitcoin right now, most of the traders will jump on the bandwagon and buy even more because out of greed. At the same time, the sellers who are against Bitcoin are going to panic and cover their positions and get out of the market out of fear. You see, it's the same emotions. They're the same, greed and fear. So this collision between extreme fear and extreme greed is the reason why we have trends in the market. Because if the emotions were balanced at all times, then the market would always stay stagnant between 2 points, just like this chart. Neither the buyers or the sellers have any motivation to break above or below demand or supply levels. So what we need to look for is the emotional imbalance in the market. because that's when we can have an edge and twist the odds into our favor. Which will take me to my third and final point, emotional imbalance. One of the legends in this field, Jesse Livermore, once said, all through time, people have basically acted and reacted the same way in the market as a result of greed, fear, ignorance, and hope. That is why the numerical formations and patterns recur on a constant basis. So basically, he summed up everything I was trying to say in just 2 sentences. That's why he's a legend. But this is the reality. The main factor that is moving the market is our emotions, and especially fear and greed. So our job as traders should be to locate the emotional imbalances in the market and take advantage of them. Now let me show you a real example of one of my trades that I took a year ago using this method. And by the way, this has been my best trade so far in the Forex market, and I'm not trying to brag or anything. I just wanted to show you the possibilities once you adopt this perspective and use it in your strategy. So let's start. The trade was on the dollar Turkish lira. And on July 16, 2016, this chart intrigued me for 2 reasons. The first reason is because it has a very clean bullish trend, which means there is one emotion which is in control, which is greed. And the second reason is, in the last year of this chart, price was trading in the same, let me zoom in. Price was trading in the same place between 2 points, which is the emotions are balanced. So when the emotions are balanced in the market, that means the market doesn't have any bias. So when the market doesn't have any bias, then you don't have an edge. So what you need to look for is the emotional imbalance to have an edge. So I waited for 4 months until November 1, when price, for the first time, started trading above the supply line. Now this means that the greed started to be in control once again. And the sellers started to panic. So I took this trade based on greed because now they have the advantage in the market. The market gave me a bias, and greed was the dominant emotion. And after a few days, price went up 1,500 pips. But it didn't stop there, because this confirmed that the emotional imbalance is in fact playing its door. And after this, price kept going, and I kept adding more and more. Why? Because the market was making new highs, and when the market is making new highs after this kind of breakout, it means that greed is in full control, and the sellers are getting afraid. So you take advantage of that by trading against the sellers. So you keep adding until you see weakness. So I kept adding. November 24, 4th entry. Up until this point, I was up 8,000 pips. I wanted to take profits, but I stayed with my strategy. And December 3, this was my 5th entry. Up until this point, I was up 11,000 pips. I was going insane, but I did a mistake over here. I got greedy. I didn't take any profits. And when you get emotional in the market will punish you. And just a few days later, price pulled back, which is a very normal pullback after this big move. But I got scared, so I took profits, 8,000 pips. I was very happy, I'm not complaining. But it was wrong because it was based on fear, not technical. So after this, the market kept going up to the point that it created another emotional imbalance in the market. But this time I didn't participate because I was emotionally exhausted from the first trade, so I wasn't ready to take this trade. And the rest is history. So when you develop the ability to pinpoint the exact location where extreme fear and extreme greed are going to intersect and create an emotional imbalance in the market, then the possibilities are limitless. But here's the catch. The only way to be fully aware of those emotions in the market is when you have gone through them all, one by one, multiple times. And this is exactly why mistakes are necessary, because you need to have a first-hand experience feeling greedy or being fearful. You need to know how it feels like to panic. You need to know how it feels like to be blinded by greed, because that's how you'll be able to predict where the majority are going to where the majority are going to panic or get greedy and use their emotions against them. So before you can start predicting those emotional imbalances, first, you need to go out there and make mistakes. Thank you.
شكرا.